Joachim, let's begin with you, sir, and just look at what the Fed is doing with the balance sheet, whether investors are right not really to be concerned, and walk me through what they're going to do in the coming months. Yeah,
well, Jonathan, the Fed wants this to be like us watching paint dry. So they say this will be very boring. You know, it's all pre-announced. It's been very transparent. There was no surprise in the announcement yesterday. And so I think we'll be watching a quantitative tightening in slow motion. So I think the baseline is that this will not have a major impact on markets. But I think there's huge uncertainty around that because there's really no historical precedent for a central bank running down its balance sheet. And I think we all remember how QE helped to raise asset prices. It lifted all the boats. It reduced not only the term premium in bond yields, but it also reduced risk premia in other markets. So I think, there's at least, a decent chance or risk that we will see some upheaval in the markets. Maybe not quite yet, but the Fed will increase they will run down their balance sheet at a faster pace each quarter. And then if you get more treasury issuance over time, especially if we get some fiscal stimulus next year, then this could have a bigger impact on both bond yields, but also on risk assets.
Joachim, at the moment, though, investors, as you point out, it's something investors have never experienced. It's something central bankers have never done. But kind of the central bias at the moment is just to buy the story that it's going to be OK. You kind of touched on it. When you sit around with the portfolio managers at Pimco, is that the view over at Pimco at the moment, that it will be OK, or that actually it won't be and it's going to be a 2018 story?
Well, we think in the near term it's going to be OK. That's at least the baseline view. But as I said, there is huge risk around that. So there is uncertainty. And so this is why we emphasize caution in our own investment approach.
Sebastien, what about the possible fiscal stimulus that Joachim just talked about? How likely is that at this point, particularly tax reform coming out of Washington?
At T Rowe Price, we're in Baltimore, so our analysts and portfolio managers like to spend some time with insiders in Washington. And we've formed a view that the likelihood of tax cuts, of something happening, tax reform, is probably higher than what's priced in. If you look at the performance of growth stocks year to date relative to value stocks or large caps relative to small caps, it doesn't look like the market is really pricing in the tax cuts, setting aside the high valuations to begin with. So for us in our portfolios, it means we're thinking very hard about this rotation between value and growth. We've even been talking about the Trump trough. You had the Trump trade post-election, and then you had the growth rally year to date. And now we're facing a situation where perhaps there's a return of the cyclical. So we've been moderating some of our overweight growth positions.